Okay, we'll get started. Those who come in late, presentation gets better as it goes on. So they are not missing too much to start at the very beginning. So my name is Jordan Tarasoff. I'm a client-facing advisor at PWL Capital. And I'm joined today by my colleague, Braden Warwick. Braden, his title is Financial Planning Product Architect. He builds awesome tools to help us figure out and solve client problems and give them great advice. PWL Capital is an independent wealth management firm based in Canada. And we help Canadians plan and make great decisions with their money. So for today's presentation, we're covering something that is very top of mind. Recently, capital gains rates, the inclusion rate for corporations changed. That changed a lot of how we approach planning. And so we're going to go over a few strategies that we use in light of the new rule changes. As we go through the presentation, my colleague, Ben Wilson, is going to be monitoring the chat and he'll be helping to provide resources to expand on what we talk about, as well as answer questions in the chat. And at the end, we're going to have time set aside to answer questions. I don't know that the slide deck is available, but we are recording this and we are going to put it on YouTube. So if you want to come back to anything we discuss, we'll have a link distributed shortly after we tidy it up and get it ready for everybody. All right, so jumping into things, I'm sure everyone on the call is aware or is close to aware that capital gains inclusion rates changed. Before we get into the nitty gritty on the tax consequences of holding investments in the corp, we want to talk about a pretty common problem that we see for incorporated professionals and business owners that we work with. So the first problem I see business owners ask is like, hey, how do I make money? How do I get customers? But once that problem's solved and they start making money, the question is, as an incorporated professional or as a business owner, how do I get that money out of my business account and into my personal bank account? The two most common ways they can do that are by paying themselves a salary or by taking dividends. And so typically what we see is people will choose one strategy and that'll kind of be what they do for the majority of their career, the majority of running their business. So from the salary perspective, it has lots of benefits. You get to pay into Canada pension plan. It could be more tax efficient. You get to create RRSP room. From the dividend perspective, you might pay less tax on your personal income statement and you get to skip CPP contributions. You have a bit more flexibility there. There's lots of different things that tie into this. But typically what we've seen in the past is the client's accountant will say, hey, I think this is best as a general rule of thumb. Let's pay you salary to max RSP room and pay dividends for the rest. Or, hey, let's just pay you dividends all the way through because paying less personal tax is a way better approach. So we've seen a lot of rules of thumb and general heuristics on how to pay yourself, but we found that was insufficient to actually give clients great advice on how they should structure their compensation moving forward.
Thanks, Jordan. So like Jordan touched on, there's a lot of rules of thumb going around with income planning for business owners. And I can say with my own experience, I come from an engineering background, specifically in the aerospace industry. And I can tell you for a fact that rules of thumb aren't going to fly in the aerospace industry. And I'm a big believer that rules of thumb shouldn't be flying in terms of the financial well-being of Canadians as well. So that's why we've taken a more engineering problem-solving approach into navigating the compensation decision. And last year we introduced an algorithm on how to prioritize different types of compensation from a corporation. And we introduced this in a pretty lengthy white paper that Ben Felix and I released, as well as I gave a talk at IFP last year going into this stuff in detail. And I don't want to recap it here, but I do want to discuss some of the improvements that we've made to the algorithm since then. So one of the big findings that we unearthed this year was that with the previous algorithm, we were prioritizing the capital dividend first and foremost, which made a ton of sense at the time. It's tax-free personally. Why wouldn't you want to prioritize it? But what we found is when we're looking at the overall tax rate, when we're combining corporate tax and personal tax together, for folks with a low personal marginal tax rate, these RDTOH refunds actually give a negative tax rate overall. And what that means is that you'll actually get more money back in your corporation than you're going to have to pay out personally. So it becomes even more attractive than the capital dividend that's tax-free. So in addition to that, what the Looney Doctor, Dr. Mark Soth, accurately commented on the Money Scope podcast and in his own blog is that tax refund into the corporation is nice, but it's also not fully, it's not the last time that money's going to be taxed. So there's another layer of tax that you'd have to pay personally to get it into your hands and actually spend it. So what he calculated were break-even income levels, as if that tax refund were to be paid out as a non-eligible dividend, which is kind of the worst case scenario. Because in reality, a lot of the time that refund is going to be reinvested inside the corporation, which will lend itself to creating more capital dividends and more RDTOH dividends in the future. So what we're doing is we're actually looking at both algorithms and both break-even points side by side. And in some cases, it makes a lot of sense to pull out RDTOH dividends up to the personal marginal rate of 38.33%. And in other cases, it makes a lot of sense to use those income breakpoints as the cutoff. So that's one big finding that we found, is just prioritizing those RDTOH dividends makes a lot of sense in those cases. And the other addition, which makes this whole chart look super complicated, is kind of this decision tree. And it's really just to capture an edge case that previously in 2023 was definitely an edge case, but due to the change in capital gains inclusion rate, we're seeing this come up fairly frequently now. And it's just due to the folks that decided to realize gains in advance of the deadline, they end up with a massive CDA balance. And in some cases, they have enough capital dividend to spend for the next year or so. So what do we do in those cases where we have a really low taxable income and say, for example, we still have RSP contribution room available? How do we handle that? And that's where this sort of decision tree comes into play. And what we realized is that if there's a large RSP contribution available, but no taxable income, we can take a little bit extra salary to cover the RSP contribution plus the basic personal amount. So that way the individual is still going to be paying no personal tax, but because the salary will get deducted off of the active business income, the overall combined tax rate is negative again. So that's what we added, and after CDA and also after personal taxable withdrawals as well. And then the rest is more or less the same. So we just wanted to give a kind of high level overview of what the taxation of $100,000 capital gain looked like before June 25th and what it looks like after. So previously, $100,000 capital gain, 50% of it would be taxable, 50% would be non-taxable, and that 50% can ultimately be paid out tax-free as a capital dividend. And then the taxable part gets taxed, and then there's a bit of that can get refunded down the road as well. But now, in this higher inclusion rate world, 2/3 of that gain is now taxable and 1/3 is non-taxable. So that decreases the amount that we can pay out tax-free to the owner and increases the amount of overall taxes and the corresponding refund as well.
Yeah, so maybe I should have said that this presentation is going to oscillate between very technical and not so technical. But in simple terms, taxes went up on capital gains in corporations. And so if we look at that from a returns perspective, that means that after taxes, the rate of return on capital gains went down. So here I modeled things, ignoring NRDTOH and refundable taxes, all of that. But just before, if you had a capital gain of 7.5% and realized that in a year, you would have netted 5.63 at the corporate level, approximately. Whereas now it's about 10% lower. It's about 5%. And so if returns go down, that has plenty of implications for clients who are currently saving, as well as those who are retired. And so what this has done is increased tax drag for assets which are retained inside a corporation. So if we compare an accumulation, a client who's adding money to their account over time, we can see that in the next chart here, that we've seen the chart before. It's like, hey, here's the effect of fees on your portfolio. It erodes it over time. The same thing happens with the higher tax rate. So I compared saving $50,000 a year and realizing capital gains every single year, which most people don't actually do. But in the worst case, someone ends up with about $400,000 less after 30 years at the new inclusion rate. Said in other terms, to end up in the same place, they would need to save 11% more per year to end up with that same amount of funds. But planning is super interesting, right? If it was as simple as just saving more, our jobs would be pretty easy. But saving more means spending less. So if you spend less, you need to save less. So the actual balance is somewhere in the middle, where clients don't need to fully save way more to make up the difference. They need to find some sort of balance between the two. But what I modeled here was the worst case. So having a capital gain accrue and then selling it off immediately at the end of the year, every single year. As long as you defer triggering capital gains, then the impact is less, because the money that you eventually are going to pay to CRA in taxes is retained inside the investment and attracting compound growth over time. And so if you're an individual or an advisor who is trading and buying stocks yourself, you can choose not to realize or realize when you want, when makes sense. But very often, if you're using a managed type product, the triggering of capital gains is not up to you. And so if we look at different investment strategies, we can see that how you invest is going to determine how taxes are charged each year, which is going to determine your tax drag. So when you use something like a market cap weighted index fund that's made to look like the market, it doesn't trade that much, because if a stock goes up in value, it goes up in your portfolio. You're not buying or selling it. If it goes down, it goes down. Again, you're not trading. So the turnover on a systematic or index type portfolio would be really low. So you're realizing a very low percentage of your gains each year, which reduces your tax drag. As soon as you start to become more active with your trading, then you increase the frequency with which you realize gains, which means you increase the amount of taxes the corporation pays each year, and you slow down growth. And so now when you're comparing investment strategies, you can't just compare the pre-tax rate of return to see which is better. You need to look at what's happening after tax. So if you have an alternative strategy where it's constantly rolling over managed futures or something like that, and you're comparing it to an index fund, it needs to beat it on after-tax returns and be suitable from a risk perspective as well. So what this means is that the hurdle rate to move away from what we see as the default and the good fit for most people, low-cost index fund investing, the hurdle to move to an alternative, higher frequency, more expensive trading strategy just became higher. So as a firm, we didn't change our approach. We were already using low-cost systematic investing. But for investors who are evaluating what kind of products they should hold inside their corporation, the hurdle rate to move away from the default portfolio just became higher. If you're going to realize your gains every single year, those gains need to be high enough to make up for the difference that you're going to pay in taxes every single year. So for taxable investments, we prefer to use low turnover, low cost products. You save on fees, you save on annual tax drag. But then a lot of the work that Braden and the rest of the team is doing is saying, hey, what if we can find a way to negate taxes altogether? What if we have less money inside the portfolio and inside the corporation and more money in other vehicles that aren't even exposed to this annual tax drag? Oh, you're on mute, Braden.
Sorry, thanks, Jordan. We want to switch gears a little bit now and talk about a tax deferred vehicle and what the difference is between a tax-free vehicle like the TFSA and a tax-deferred vehicle like an RSP or an individual pension plan, IPP, for business owners. So what's interesting and what's often not thought about is that if you think of the RSP or the IPP as investing your money and a little bit of the government's money, you end up with the same outcome. You end up with a tax-free portion that belongs to you and a taxable portion that belongs to the government. And if you just ignore the part that belongs to the government and only concentrate on the amount that's yours, you end up with the same result, regardless of if you're investing in a tax-free vehicle like the TFSA or the RSP or IPP, assuming that the marginal tax rate is the same throughout. So I mentioned the IPP. The IPP is it's a pension plan that business owners can take advantage of. And the attractiveness is due to the increased contribution room over an RSP. So you get more tax deferred space than you would have if you just have the RSP alone. The chart in the middle here is showing the RSP contribution in real terms over time, and it's flat. But we see that the IPP contribution gets larger with age. And the calculation to determine an IPP contribution is quite a bit more involved, and it's done by actuaries, but it is dependent on your age. So we see it grows with time, and we see at the younger years before 40, we actually see that the RSP contribution is higher than the IPP contribution. So we typically wouldn't recommend setting up an IPP, if it makes sense at all, until over the age of 40, in the early 40s somewhere, where the added benefits in terms of contribution room outweigh any added costs associated with operating the account. But what's important to note is that even if you're under the age of 40 and the plan is to open the IPP in the future, the planning has to start now. And the reason for that is because of the concept of past service contributions. So once you decide to open the IPP and you're of the appropriate age, you can buy back past years of service. And that calculation is driven by the amount of T4 income that you've had previously, specifically T4 income coming from your corporation. And so if we make the decision, say at 35, that at 41 we're going to open up an IPP, it's important that we do pay out enough T4 income from the corporation to maximize the contribution amount and maximize the past service funding. So we'll get an additional amount when we first open the IPP that can come from the corporation. So getting money that would be taxable in the corporation into a tax shelter. And then we can make contributions throughout our working years until we hit retirement. And then at retirement, there's an even bigger opportunity to make an even larger contribution. So we see this chart, this table on the side here showing at age 65, we have an opportunity to make an $800,000 contribution to the IPP as an example. And again, that would be taking $800,000 that would be taxable inside the corporation and exposed to this capital gains inclusion rate change, and we're getting it into the tax shelter where it would be not exposed to those ongoing gains. And the last opportunity with IPPs that I want to touch on today is the notion of a top-up opportunity or a contribution holiday. And how it works is that every 3 years, you have to get your IPP evaluated by an actuary. And the actuary is going to compare the performance of the investments inside your IPP to a benchmark that's established by the Income Tax Act. And you'll see the benchmark is the solid blue line. If your IPP happens to do well, because stock markets are doing really well, say in this range of the chart here, and it's exceeding the benchmark plus 25%, which is the dashed line, then you'll have to go on a contribution holiday, which just means you'll have to pause contributions until your IPP is no longer exceeding 25% more than the benchmark rate. And but what's more exciting is in the cases where the IPP performance has been bad, it's underperformed the benchmark. So say at age 54 here, when we're getting the valuation, the red line is the IPP exposed to randomized returns, and it happened to do worse than the benchmark. So it creates a top-up opportunity where the difference between the benchmark and the actual valuation of your IPP, you can add that contribution equal to the difference between the two. And what's not shown here is that you can have the valuation done whenever you want. So for example, in March 2020, when COVID hit out of nowhere and the markets plummeted, the value of people's IPPs would have also plummeted. And if you took the opportunity to have a valuation done at that point in time, you could have generated a massive top-up opportunity to take money out of your corporation, which when we're thinking, again, the time frame here, it's very likely that money would not be exposed to capital gains at that point because the markets dropped out. So you'd be able to sell off funds without paying added tax, get them into a tax shelter where now, because markets have dropped, we have the highest expected return. So you're getting the contribution at the added contribution room at the time the markets would have the highest expected return moving forward. So we don't believe in market timing, but it is a kind of interesting sequence of events where we're able to take out money with no tax or minimal tax implications, get it into a tax shelter at the time where there's the highest expected return moving forward.
So as we can see, we were big fans of IPPs before, but now that corporate taxes on capital gains have gone up, the value of a tax shelter is even bigger. But with the seeing what the impact of adding an IPP to a plan versus not adding an IPP, we can't use straight linear rates of return. Because as Braden highlighted, the path that markets take while you're adding money to the IPP is going to impact how much money you can add to the IPP. So if markets go up and up and up when you're trying to add money, that's great that you had fantastic investment returns, but more of them are going to be in a taxable environment than in the tax shelter. If markets drop while you're contributing, then more money is going to be in a tax shelter than not. So your upside is capped a little bit more, your downside is capped a bit more as well. And so the way that we evaluate the decision to create an IPP versus not is through simulation. And we use what's called a Monte Carlo analysis to determine how much it will improve a client outcome. So this is a simple presentation that I give to clients when I'm explaining what Monte Carlo looks like. And so it's two clients, two different retirees, each with identical returns over time. They both got 6%, but the order in which they receive these returns are inverted. So if these two people met at a cocktail party at age 90 and said, hey, how's your broker doing? What return did they get you? They would think they got the exact same result. They both got a return of 6% from age 65 to 90. However, one person had really strong returns early in retirement when they had a lot of money and poor returns late. The other had poor returns early and strong returns late. And so we can see that even though they got the exact same return, where they ended up is completely different. So the first person on the left is saying, hey, I have an extra $2.5 million. What can I do to benefit my family with this money? The other person ended up running out of money at age 83. And so a lot of planning we see out there is straight linear rates of return, but that doesn't accurately capture what the retirement experience is going to be like. We care a lot about when the returns happen, not just what they are in planning projections. And so when we're simulating, how does an IPP impact a retirement plan? How does it benefit a business owner? We run many simulations. So in this example, we can see someone basically maintained their net worth through retirement. In another simulation, they had strong returns early, which means that they ended up accumulating more money from the time they retired till later. In this one, they had poor returns early. They're selling from the portfolio as the markets drop. They're selling their investments while they're on sale. When the markets eventually do recover, the money isn't there to recover. And so they end up running out of money early in retirement. So we run thousands of simulations like this. And what we see is the distribution of plans that succeed versus the plans that fail, as well as what the average net worth is at the end of these plans. And so one of the limitations of Monte Carlo is that it assumes that clients and people who are retirees are stubborn and dumb and don't react to seeing problems come. In reality, what we do is we run a financial planning projection. And if it starts looking worse and worse, we'll say, hey, hold on a second. You're in the right tail or the left tail of the distribution. Things are bad. We better spend less, go back to work, make some modifications to your plan. And so traditional Monte Carlo analysis just says, hey, look at that, you failed. You shouldn't have gone on that dream vacation at the bottom of the markets. In a separate, not related to this presentation, but Braden's built tools that will model, hey, what happens if we react to market downturns? What happens if I want to spend 10,000 a month, but I'm willing to cut it to 8? How much more sustainable is this plan? Will this plan be? And so what we want to highlight here is that financial planning isn't, hey, you're getting 7%, things look good. It's, hey, we expect you to get a return with a mean of 7%, but this wide of a distribution. How often do you succeed? How often do you make downward or upward adjustments? So when we're evaluating the IPP, we didn't just say same returns every single year. We did simulations where when the markets dropped, you added more money. When the markets went up, you added less. And then we looked at what were the results across all these different simulations of all these theoretical different retirements and different accumulation phases.
So to look at this analytically through, all of the lenses that we've been talking about, we did a case study to investigate how the business owner is going to be now that capital gains have gone up. So we looked at using capital gain inclusion rate of 50% before June 25th, and then the new 2/3 inclusion rate after. We set the case study to be a client that would be a business owner and an ideal candidate for an IPP, so that we could look at the impact of the IPP on this whole inclusion rate discussion as well. So what we found was that at the old inclusion rates, the IPP gave about a 2% benefit over the RRSP in this particular case. And now at the new inclusion rates, we see about a 3% benefit over the RRSP. So what this is telling us is that the tax shelter becomes more attractive in a higher tax environment, which is pretty intuitive. But what's even more interesting from my perspective is when we look at what the net worth is before and after the inclusion rate change and compare that to the change in sustainable spending before and after. So if we're looking at net worth, it's a drastic change, regardless of what strategy you're using, regardless if you're dividends or salary or an IPP person. It's a pretty substantial hit in terms of net worth. But what's interesting is that the sustainable spending amount barely changed. And it seems kind of counterintuitive at first, like why would there be such a difference in the two? But it makes a lot of sense when you think about it. And before I get into why, I just want to touch on one point, is that sustainable spending, the way we calculate it, is using the Monte Carlo that Jordan highlighted. So we're actually, when we try to think about how much can the client safely spend, we look at the 10% worst outcomes. So we want to make sure that the Monte Carlo success rate is 90% successful. Only 10%, the worst 10% of those outcomes run out of money at some point, and that's what we use as a constraint. So when we actually look at what the distribution looks like, we see that with the old inclusion rate, we see a much wider distribution. But the interesting piece is that increasing the inclusion rate really only brings the high end down, and it doesn't really have much of an impact on the low end. And the reason is because in these best case scenarios, there's a ton of capital gains that that's occurring inside the portfolio. You know, and investments have done really well, better than expected, and as a result, they're going to be taxed. And a higher tax rate is really going to pull down those outcomes. But in the worst case scenarios where the markets are not doing well, there's really not a lot of capital gains going on. So a change in inclusion rate doesn't really impact the outcome. So that's why we see the sustainable spending amount not being as impacted by this inclusion rate change, because we're already being relatively conservative and ensuring a 90% success rate before we before we recommend increasing spending. Okay, so I'm going to shift gears now, and I actually want to take some time to go over the planning tools that we've created to implement the optimal compensation strategy. So, you know, the initial part of the talk was kind of a bit of the theory, a bit of the rationale behind it all, but what's even more important, in my opinion, is can we take that theory and can we improve the financial well-being of our clients? And that's where the tool set comes in. So I'm gonna shift gears over to the tool set now. So this is the optimal compensation tool that we've recently built. And you may, if you've used the realize or defer gains calculator that we made public a few months ago, you may be familiar with the interface, but it's the same interface in the sense that we're comparing different simulations. But now, instead of comparing should I realize or defer a gain ahead of the June 25th, now we're just comparing different compensation strategies and seeing which ones are better. So in this particular case, you see the optimal compensation strategies all performed relatively similar, generating a final net worth of about 8.9 million. But the dividends case runs out of money completely, and the salary case only ends up with 2.7 million. So we see that using our optimal compensation strategies added a final net worth of about 6 million if we're using salary case as the benchmark. And it really is just quantifying the value add of our financial planning. And it's a pretty stark difference if you're going down the path of dividends. Say you're you don't know any different. You're not getting good financial advice from your advisor, and you're withdrawing a non-eligible dividend. You're going to end up running out of money compared to someone who's taking our advice using the optimal compensation algorithm. That person might end up with 9 million left at the end of the day. So for our advisors, once we've decided on, okay, optimal compensation makes a lot of sense, and here's the value add, the tool allows you to show off like how we would expect that compensation to evolve over time. So here's a chart showing kind of the year over year breakdown of compensation and what that looks like, and the different buckets that it's pulling from depending on how the notional accounts are evolving over time. And it also includes other income sources like CPP benefits, OAS benefits, RIF minimum withdrawals, and so on. And then finally, for really diving into the weeds, the advisor can get a line by line breakdown of all of these different sources, and it'll tell you the breakdown of eligible dividends in terms of eligible dividends that trigger the RDTUH refund, eligible dividends that are from GRIP, for the really nerdy financial planners. But the key is like we have a summary now of what the plan is going to be, where the different sources of compensation are coming from, and we can look at that year over year. We can dive into any of the years we want, and for any of the strategies that we're considering. So now I want to flip back to the net worth chart and just show a different study. So this is for somebody that would be spending down the portfolio. And for somebody, maybe their spending is a lot less. They're they have different goals. They want to leave a larger legacy, for example, and they're content with spending below their means. This is where we see the difference of the new algorithms that I talked about at the beginning of today's call. So we see now that in this particular case, the optimal compensation algorithm that prioritizes taking RDTOH up until 38.33% is performs significantly better than our old algorithms. And we can see what that compensation difference looks like. If we compare, say, the CDA, the old algorithm here, with the new one, we end up taking significantly more money out of the corporation and investing it personally, just to take advantage of that lower tax rate. And again, we can see the full breakdown year over year. And there's one more thing that I want to highlight in this tool, is that we've also solved for the common client question of, I want to do a home renovation in 2 years from now, and I'm going to have a lump sum expense that happens. How should I handle that? How does that change my compensation? So the advisor can go in and enter in $100,000 lump sum expense happening 2 years from now, and it'll reevaluate. And what this will actually do, it'll automatically tell the advisor whether or not it makes sense to smooth that expense out over the upcoming years. So if we go back to the compensation chart, you'll see now spending is the green line. You'll see all 3 years, 24, 25, and 26, are all higher spending than they would have otherwise, in comparison to the benchmark strategies, which just show that massive lump sum coming out all at once and exposing the individual to a much higher tax rate all at once. So in this particular case, it did make a lot of sense to smooth out that income over the years leading up to the expense, but that's may not always be the case. So there could be cases where maybe there's enough CDA, capital dividend, to cover that expense tax-free in the year. So maybe you don't have to do planning for it. And in that case, the software will tell you, no, you don't need to smooth expenses. And then the chart will show that lump sum expense happening all at once, and it'll show it being covered by a capital dividend or by a withdrawal from a personal taxable account, or whatever the case may be. So I'm going to pause on the screen. Maybe if there's any questions. I haven't seen the chat, but we could open the floor now.
There's one in there that is pretty relevant to you, actually, from Scott. I'll read it out. Have you run any scenarios for ultra high net worth strategies? Business owners earning over 1 million per year with large business value at retirement, say 20 million. Is deferral the priority?
Yeah, it's a good question. I haven't explicitly looked at that case study, but it would be interesting. We just thought of one today, actually, where it might be worth looking into having a strategy whereby you take salary to reduce active business income down to the small business deduction threshold, and use that as a point of comparison. We haven't explicitly run that, but we could easily add that to the framework to see if that is a value add strategy, or if it still underperforms compared to our algorithms.
Perfect. And another question on the actuarial fees for the IPP. So it's, I don't know, I guess modest is in the eye of the beholder, but I've seen it's between $1,500 to $2,000 per year, every year, for the actuarial fees to keep an IPP set up. The setup cost, I can't quite recall. Do you remember, Braden, how much it costs to set it up? Is it the same?
I believe it's the same. Well, we primarily deal with West Coast actuaries, and I think they kind of smooth out that expense, so it's constant year over year.
Yeah, like they charge in the years that they're not doing the valuations, so you don't get a big bill in the year that you do. But yeah, if you ballpark between $1,500 and $2,000 a year, that's roughly what it costs. you wouldn't set it up until after age 40. And in most scenarios that we see, the tax savings benefits far outweigh the incremental cost of having the actuarial fees there. Just a comment on the 2 QR codes that we're showing on the screen here. So as a firm, PWL, we're looking to work with new families on the financial planning and wealth management side of things. So we're portfolio managers. We do comprehensive financial planning, manage client portfolios, set up IPPs, help them manage it, do corporate income planning, all of that. So if you're interested in meeting with our team, you can use the QR code on the left, and we'll do a quick 15-minute call, chat about what you're looking for, and see if it's a good fit and who the best advisor on the team would be for you to chat with. The QR code on the right, we noticed that a ton of people registered for this presentation are already professionals working in financial planning or accounting, that sort of thing. And so as a firm, we're also looking to meet with and partner with like-minded advisors. And so if you're interested in seeing what it's like to work with PWL, what kind of tools we have access to, our systems, our processes, our team approach, that QR code lets you book a time with Cameron Passmore. Cameron is our executive chairman. He's kind of in charge of all of the partnerships, that sort of thing, meeting with other advisors. And he's super easygoing. So if you're just curious what it's like to be an advisor at PWL, I encourage you to book a time with Cameron, talk shop, chat about what you're looking for, your problems you're trying to solve. And worst case, just add to your network of people in the industry. Perfect. And we have lots of time for questions. So if people want to put them in the chat, or even, the chat, or there's the Q&A field on the side. Braden and I will stick around to help answer those questions. Okay. So we have a question from Trevor. How much do you need in your IPP to make it worthwhile? And so Braden, feel free to chime in on this, but one of the biggest things for the IPP is you need to have enough revenue to both pay yourself enough to maximize the room and to fill the account. You need to have enough profit to do so, basically, with profit, revenue, that kind of thing. So how much do you need to do to max out the room right now, Braden? Do you know?
Well, it's the same as the RSP.
180-ish?
Yeah, around 180K.
Yeah, so it's 180K. But with an RSP, what you do is you pay yourself 180K, and then 30K of that 180 goes into the RSP. The IPP is funded directly from the corporation. So you need to pay yourself the 180 plus take an extra 40 to 50 from the corporation and put that straight into an IPP. So if you're not making enough money as a business to do both those things, then your RSP room will likely be the same as your IPP room, and it's not worth setting it up. So this is for people over the age of 40, business owners over the age of 40 with sufficient income to maximize the room. It's not worth paying to set up an IPP if you can't contribute more than the RSP limit in most cases.
And to add to that too, to really take advantage of terminal funding and the past service contribution, you typically want to have those funds available in the corp as well. So, and particularly terminal funding, those amounts can be like around $1 million, like we saw earlier. So again, it's not a deal breaker. It's IPP still might make sense without terminal funding, but it definitely adds fuel to the fire if you have that money in the corp and you can get it in the tax shelter.
Mm-hmm. Yeah, one of the metaphors I use often is that you want to use dams to basically slow down cash flow from hitting your personal tax return. The corporation used to be a great dam, but they recently increased the tax rate on it. IPP is also a way to store funds, but you have naturally occurring ones as well. So you have your tax-free savings account, everyone gets your RSP, everyone gets if they pay themselves salary. These are naturally occurring free accounts that you can set up to maximize. It's only once you're exceeding those limits, then you start to get into more complicated strategies like the IPP and other things like that. Lots of questions coming in now. Can you see them, Braden?
No.
Okay. Here's one. Do you have to transfer your RRSP to your IPP when you set it up?
So that's a calculation that's done by actuaries, and it's not the entire RSP. It's some amount that the actuaries will determine. But once they've determined that amount, that is the amount that will have to be transferred. and the remaining amount will have to come from the corporation. So if you don't want to do that, the past service contribution is optional. You can choose to buy back as many years as you want. So for someone that may has 20 years, you don't have to necessarily purchase them all. It's kind of whatever works for you, but the ratio of what comes from the RSP to what comes from the corporation is not really flexible at all.
Yeah, you can't choose to keep your RSP and do an IPP from scratch. Yeah. Okay. Are IPPs efficient for you looking to transfer your business to the next generation? Can there be more tax deferral? Because the IPP sticks, correct me if I'm wrong, Braden, but I think the IPP sticks with the corporation. If you want to like transition your business, you'd have to open a whole co and move it and then transition the opco, right?
Yeah, I believe so.
Yeah. So it can add some complexity for the transition of a business. So it's super straightforward for like a professional business, like a doctor. They're not really going to sell their doctor corporation. They're just going to keep it in perpetuity. But if you have an operating business that you want to sell, that takes more involved like legal and accounting type planning, because you want to be able to take advantage of both the tax shelter of the IPP and the tax benefits of selling the shares of your corporation for the lifetime capital gains exemption. So that one's pretty tough. It's kind of case by case. Here's one from Christine. Could the IPP be funded with existing investments held in the corp, or do you need income? Is something about income that triggers the benefit? Active business income she's referring to.
Right. So you need, it doesn't necessarily matter where the money is coming from, but in order to create IPP contribution room on a year-by-year basis, you need to be paying yourself T4 income from the corporation. So it's kind of a similar mechanism as RSP. You know, if you pay yourself, you know, your RSP contribution room moving forward is proportional to the amount of salary that you earned, you know, in the previous year. So it's a similar concept in that. It's just a more involved calculation to determine exactly what that contribution amount is going to be.
Perfect. Here's one from Malcolm. When would you recommend setting up IPP early, age 40, versus waiting until later, like age 65, assuming that you can maximize the IPP in either scenario?
That's a interesting question. I'm not sure if we've really looked at the cases of waiting until 65 to create an IPP, but you're definitely going to be missing out on top-up opportunities that would occur throughout the lifetime, which, as I mentioned in the call, can be pretty substantial if you can time it right. So that's one obvious benefit that you'd be missing out on waiting until 65. But you would be able to purchase past years of service. So I guess with the caveat that I haven't directly modeled that, I will say that it seems on the surface that you'd be trading in the ongoing actuarial fees of the IPP for the loss of any sort of top up opportunities.
Like the time weighted balance of your tax shelters would be lower because there's no money in the IPP from 40 to 65, right? So
Yeah.
Any growth that you accrue during that time would be in a taxable environment, not in a tax-free environment or tax sheltered environment, but you're paying the $1,500 to $2,000 a year.
Yeah.
Yeah, that makes sense. Okay. We have one in the chat as well. I'm curious what your algorithm would say for a higher income Canadian, a marginal tax rate of 43%, while paying out the CDA that isn't needed for cash. Surplus would go to a personal investment account. Would it partially depend on whether the corp has cash to pay out the CDA, or whether a gain would need to be triggered to pay out the CDA? I hope that makes sense. So essentially, if you're at a high tax bracket, does it make sense to trigger gains to pay out CDA to invest personally or something else? This ties really into the calculator you built for June 25th.
Right. So I guess it depends. So the way the algorithm is set up is it will always pull CDA, assuming CDA is over some sort of minimum balance where it makes sense to make the CDA election from the added accounting fees associated with that. So for somebody, I'm trying to follow your example. I'm assuming it would be someone who has outside income. So maybe, maybe they're a physician, but they're also a professor and having a T4 income from a university, and maybe that's enough to cover lifestyle. And maybe that's pushes them into a high marginal rate. So yeah, the algorithm would always pull that CDA out when it makes sense, or when it crosses that accounting threshold. But yeah, it would be good to run those side by side to try to quantify that benefit for sure.
We did see it often makes sense if you have TFSA room or high interest debt. It makes sense to pay it out because TFSA, you're getting a tax-free return. Paying down mortgage debt, you're getting a guaranteed tax-free return of the interest savings. So then it's like, hey, do I leave assets in the corporation at a high tax rate, or do I pay tax today to flow them out to a place where I get a tax-free return? When we were running the calculations, we found that usually makes sense to pay it out in that case. But Braden made a good point. If you are only paying yourself from the corporation, then you can kind of choose how you pay yourself each year. So you're not in a high tax rate by being stuck there. You can choose what your tax rate is. It's just for the example of like, yeah, I teach and I'm a doctor or something like that. All right, lots of questions here. Are there spousal rollovers for the IPP, or do you need to convert prior to? I guess prior to death. Yeah. So it stays a corporate asset, but if you've converted it into like a LIRA and RSP, then it has the normal rollover provisions in the future. So it's not like, hey, you funded an IPP and died. Now the CRA gets to keep all the money. It's not like that. It rolls over to the estate, depending on who the beneficiary is. If it's a spouse, it's sort of like a tax deferred rollover. If it's your kids, then it's more of a taxable payout. Can one IPP be set up for a couple who are 50-50 shareholders? Would an age difference complicate this? I think it has to be individual, right? It's like a defined benefit plan.
Yeah, like the corporation could set up an IPP for both of them individually. But they would have their own calculations separately, like their IPP holdings would be tracked to the benchmark separately, etc.
Yeah. Okay. Lots of questions. Well, here's one from Colin. With all the upside to the IPP discussed here, is there a clear reason to not do an IPP if you're a higher earning business owner? So I one quick example is if you have a very short time horizon, then the IPP, the tax deferral benefit is not that great. So I've worked with a family where I think he planned to retire at like 43. So you're not going to go through all the rigmarole of setting up the IPP at 40 just to have it for 3 years and then have to deal with it afterwards. So it doesn't make sense for early retirees because the real benefit of the account is having the tax shelter for a long period of time. So it doesn't make sense to keep it for a short time. Can you think of other examples, Braden?
Yeah, it's a great example, Jordan, but I want to highlight that there's really a sweet spot for IPPs, and Jordan touched on it earlier with the low income case. If you don't have enough, if your corp's not making enough money to justify, the maxed out contributions year over year, then it doesn't really make a ton of sense to set up the IPP and subject yourself to those ongoing overhead. But the flip side is also true, because there's cases where there's a ton of money in the corp, and year over year, the corp is making a ton of passive income and accumulating large notional account balances. And it might make a lot more sense to prioritize those RDTOH refunds and fund consumption off of dividends than it would be to take the higher salary for the IPP benefit. So there's really not a one size fits all solution. It really has to go case by case, but there is definitely a sweet spot where if your corporation is making enough money but not too much money, that the IPP might make a ton of sense.
Yeah. So typically you don't just go out there just selling IPPs to everybody. We typically do a pretty big deep dive on this before we do it. Okay, we got 3 more questions I see here. From what I understand, donating appreciated stocks to a charity results in 100% CDA, correct? Are there situations where donating money could be financially advantageous? So yeah, so you get 100% of the donation as a credit to the CDA when you donate appreciated shares. I'm trying to think. It could be advantageous if you have an ultra low cost base, right? Like if you had like 1,000x on your shares, then everything would be a capital gain on it. I don't know if you would net more money than selling it, paying the tax and paying yourself out though. It's very rare that you get more and the charity gets more and the CRA gets nothing. Do you know it all, Braden?
I haven't really looked into it, but I would imagine if the plan is to make a donation, like if that's already a part of the plan, then that probably makes a ton of sense. But I don't know if we would, make a donation just for the purposes of.
Yeah, I've never seen it where your retirement looks better because you gave money away. I've never seen that before. On the Looney Doctor website, I think he has a deep dive on donated appreciated shares that could go more into this. But I've never seen it where you're better off financially giving money away. I have seen where the charity's better off and the CRA is worse off, but I've never seen you at the individual level being better off unless I'm missing something massive. Okay. What's the questions here? Can IPP income be split? Is it like eligible pension income?
Yes.
Yes. Well, short answer, yes. And then also, can it roll over to a spouse? We touched on that one. Yes, it can. To a disabled adult child into a Henson Trust or RDSP. I'm not 100% on if a LIRA, because you can move an IPP into a LIRA and a taxable amount. I'm not 100% if a LIRA can be rolled over to an RDSP. That's a niche question. Yeah. Oh yeah, you can do a lift rollover. So if you're actually interested in this, we would do a deep dive, but at a high level, it seems like it has the same rules as an RSP or LIRA. But I'd be careful with that one in case that's super important to you. Okay. Are you familiar with the personal pension plan, the PPP, Braden?
I know of it.
Okay, I'm not familiar with it at all, but there's a question on it, so we can either answer it, or I think Ben Felix plans to put out some content on it as well that we can distribute.
Maybe we'll wait for Ben.
Yeah, let's wait for Ben. Yeah. Yeah, anything I said on this would just be conjecture. So we're going to leave that question, and PWL will release some content on that later. So either, subscribe to the Rational Reminder podcast or Ben Felix's YouTube channel for that one. Okay. Justin Manning, does PWL advise clients on setting up workplace RRSPs through their business to maximize employer matching and pre-tax payroll deductions? I think that question is asking, do we set up and administer group RRSPs? Maybe. So we don't set up and manage them. I have lots of clients who have a group matching program. And so we help them, obviously, like say it's 100% matching. You'd be crazy not to put your money into that. So in the planning we do, we say, okay, you're going to maximize that. And then we help them go through their provided investment options and choose something that aligns with their risk tolerance and PWL's investment values. So oftentimes there's high fee active funds inside these group plans, and then there's an index fund type option. We will help clients pick from all those different options and maximize the amount of matching that they get over time. So we advise on it. We don't charge fees on it because it's not with us, and we help them manage that, but we don't set up group RRSPs. It's not something that we do. Let me know if that didn't answer your question. Okay. All right, we're slightly over time, but I don't see any other questions. So I think we will wrap it up there. So thanks everyone for your engagement. And yeah, if you want to talk to us. Oh, which two did I miss? Ben. So we answered the question on the marginal tax rate. Yep, we answered all the ones in the chat as well. So I think we're good. But yeah, if you want to reach out, PWL Capital contact page. A lot of our advisors are active on Twitter, LinkedIn. Yeah, we're all friendly, like talking shop or talking to people who are looking to see what type of advice is right for them. So if you've never worked with an advisor before, curious what it looks like, feel free to reach out. We're all friendly, all happy to talk. And we are going to clean this up a little bit, this presentation, and then distribute it, the YouTube link. So if you want to share this with somebody else, feel free to pass it around. All right. Thanks, everybody. Have a good rest of your day. Bye.